All right, welcome to our deep dive explainer. Today, we're tackling a really big question, one that every single income investor should be asking themselves. Are those super tempting, high yield dividend stocks a safe bet? Or are they basically a ticking time bomb for your portfolio? Let's figure it out. So here's our game plan for navigating these tricky waters. First, we're going to talk about why we're so drawn to those high yields in the first place. Then, we are going to define the value trap so you know exactly what to look out for. After that, I'm going to give you the analytical toolkit the pros use, and we'll even take it for a spin with a real case study. Finally, we'll see how this all fits into a smart portfolio strategy and take a peek at the future of dividend investing. So let's get real. Why is everyone and their brother so obsessed with dividends right now? Well, it really comes down to what people call the search for yield. Just think about it for a second. The market feels kind of pricey, right? Even legends like Warren Buffett are sitting on mountains of cash because they can't find good deals. So it's only natural to go hunting for assets that will actually pay you just for owning them. That juicy dividend check feels like a guarantee, doesn't it? It feels like this cozy, safe harbor in a stormy sea. But, and this is the big question we're digging into, is that feeling of safety actually real? Or is that harbor just hiding some really sharp rocks right under the surface? And that right there brings us to the absolute heart of this explainer, the value trap. This thing it's one of the sneakiest, most painful mistakes an investor can make because it feels so right up until the moment it all goes wrong. The whole deception of a value trap is how simple it looks. A stock's price drops, right, which mathematically pushes the dividend yield way up. And your brain just goes, awesome, it's on sale and it pays me more. But hold on, the market, it usually isn't dumb. That price is often low for a very, very good reason, a deep, fundamental problem that the smart money has already sniffed out. This is, hands down, the best analogy for understanding a value trap. As an investor, that daily feeding, that's your dividend payment. It shows up in your account every quarter, just like clockwork. You feel safe, you feel secure, you feel smart for finding such a friendly investment. But you are totally, completely blind to the huge systemic risk, the catastrophic event lurking just around the corner, like a sudden dividend cut, or even worse, a total collapse of the stock price. Thanksgiving is coming. So that's the billion-dollar question, isn't it? How do we make sure we're not the turkey? How do we spot the difference between a genuine bargain and a business that's secretly circling the drain? Well, it all comes down to changing your mindset from just a consumer to a professional analyst. And that, my friends, brings us to your analytical toolkit. These are the instruments that let you see right past a tempting yield and actually diagnose the true health of a business. This is how you stop guessing and start making informed, disciplined decisions. Okay, first things first. This is maybe the most crucial idea in all of investing. Price is what you pay, but value is what you get. Price is just a number flickering on a screen. Value is the real stuff, the future earnings, the assets, the competitive edge. The single biggest mistake you can make is mixing those two up. You can overpay for an amazing company and still get crushed on your returns. Your job is to find a way to buy a dollar's worth of real value for like 50 cents. So this is how we pop the hood and see what's really going on beyond the shiny paint job of a high yield. First up, debt. Think of high debt like high blood pressure for a company. It seems fine until a crisis hits. Then, in a recession, that debt gets paid long before you do. And believe me, your dividend is the first thing on the chopping block. Second, look at the earnings. You want to see a nice, clear, upward trend, not a business that's just flatlining. A company that isn't growing its earnings can't sustainably grow its dividend. And finally, growth. This is the twin engine idea. Can the company pay you and reinvest to keep the business healthy for the future? Or is it basically starving its own future just to send you a check today? That is a huge red flag. Okay, theory is great, but let's get our hands dirty. We're going to put our new toolkit to work on two companies and see if we can tell the difference between the bargain and the trap. Okay, look at this. On one side, we've got Flashy Yield Inc., and on the other, Steady Ed Co. Now, your eyes immediately go to that 7% yield, right? It's double, looks like a no-brainer. But our toolkit tells a totally different story. Flashy Yield is in a crazy, fast-changing industry, while Steady Ed sells something boring but essential. Earnings are flat versus growing, but here's the real kicker, that debt-to-equity ratio, 5.2. What does that even mean? It means for every dollar the company actually owns in equity, it owes lenders more than $5. Whoa. Let's see what that looks like. Just look at this chart. I mean, wow. The difference is stark. Flashy Yield Inc. is leveraged up to its eyeballs. Steady Edco, on the other hand, has less than $1 of debt for every dollar of equity. It's a much safer, much more conservative balance sheet. Now, let me ask you this. A recession hits and revenue drops 20% for both companies. Which one do you think is more likely to cut its dividend to pay the bankers? Yeah, it's not even a contest. So the verdict is in. That 7% yield from Flashy Yield, it's not a reward. It's a warning sign. It's the market demanding a higher return to compensate for the massive risk hiding under the surface. It's the turkey, fat and happy, with Thanksgiving on the calendar. Steady Edco's 3.5% yield? Well, that's the price you pay for durability, a strong balance sheet, and a business that you can count on to be around for decades. Okay, so being able to spot an individual trap is a huge skill, but it's not enough. To really build wealth over the long haul, you have to fit this skill into a broader strategy for your entire portfolio. It's all about building your own system for success. Here's one way you could structure that system. The vast majority of it, say 70%, goes into your core investments. These are your high-quality, long-term assets, exactly where a company like our Steady Edco would live. The rest, you can allocate it to more active strategies, and this is crucial. You keep a slice as cash. Now, that cash isn't just sitting there doing nothing. It's your opportunity fund, ready to go when the market panics and suddenly great companies go on sale. The key thing to remember is that quality dividend investing belongs in your core, not in the speculative bucket. Now, this next idea, this is where things get really cool. It's called the wealth wheel, and it's how you can transform that passive income into an active cash flow machine. It works like this. You acquire a great asset. That asset pays you dividends. But you don't stop there. You can use other strategies to generate even more cash from the shares you already own, almost like renting them out. It's a whole other topic for another day, but the principle is simple. Stack income streams. Then, and this is the magic part, you take all that cash and you plow it right back into buying more assets, making that wheel spin faster and faster. That is the power of compounding your wealth. Okay, let's bring all this home and look toward the future. The strategies we've talked about are powerful, but they are not set it and forget it. The world is always changing, and your greatest asset as an investor is simply constant vigilance. Think about this for a second. Back in 1958, if you bought a blue-chip company, you could pretty reasonably expect it to be a dominant force for over half a century. The whole idea of buy and hold forever was really born in this era of stability. Now, fast forward to today, that average lifespan, it has completely collapsed to less than 18 years. Let that sink in. The pace of technological disruption, of creative destruction, it's just accelerated off the charts. A company that's a market leader today could be totally irrelevant in a decade. And that fundamentally changes how we have to think about long-term investing. And that leaves us with this final, critical question to chew on. A Dividend Aristocrat is a company that's raised its dividend for over 25 years in a row. That history is impressive, no doubt. It tells a beautiful story of past success and stability. But in today's fast-changing world, you have to ask yourself, is that history a reliable predictor of the next 25 years? Or is it just a beautiful story about the past? The answer to that question is what will determine whether you find a true fortress for your money or just end up as the Thanksgiving turkey. Thanks for digging into this with us.